Thanks for staying with us on SABC News. China stocks closed down today as investor optimism towards the world's second largest economy waned after the authority's stimulus policy, while a weakening yuan pressured the stock market further. So the Shanghai Composite Index edged 0.2% lower. The Hang Seng Index slipped 1% and Japan's Nikkei fell 1.1%. Let's go over to the United States. On Wall Street, stocks ended mixed yesterday, with a tech-heavy Nasdaq taking the biggest plunge after China's iPhone curbs pressured shares of Apple and its suppliers. Apple shares lost nearly 3%, falling for a second straight day. And further pressuring stocks, U.S. unemployment claims last week hit their lowest level since February. That's according to the U.S. Labor Department. So this fed worries about interest rates and sticky inflation. The S&P 500 lost 0.32%, the Nasdaq Composite lost 0.89%, and the Dow Jones Industrial Average rose 0.17%. When we come to South Africa, the JSE was mainly lower at midday. The all-share index shedding 0.1% to 73,115. The Industrial 25 index and financials traded flat. Markets in Europe are weaker at this hour. Britain's FTSE 100 shed 0.7%. The CAC 40 in France is 0.3% lower, and Germany's DAX has declined by 0.5%. The rand is trading at 19 rand and 9 cents to the dollar, 23 rand and 80 cents to the pound sterling, and 20 rand and 42 cents to the euro. Looking at commodities, gold's trading at $1,923 an ounce, platinum at $898 an ounce, and a barrel of Brent crude oil at $90.40. Let's speak to Jamil Ahmad. He's the chief trading analyst at online trading brokerage Global Trade Capital. He joins me now. Jamil, thanks so much for your time on SABC News this afternoon. So global markets are a bit steady today after a week of jitters. What data or information came out of the US, and how did that contribute to that?
Essentially, what's happening is that the US dollar continues to stand tall against all of its peers. That's what's rattled global markets over the past couple of days. Expectations were that the highest interest rate policy in the United States in years, we haven't seen such a fast interest rate increases for a generation, actually, would weaken US economic data. But in fact, the data, and the devil's always in the detail, and those details show that the United States economy is unexpectedly bucking the trend and is performing very robustly despite the global economic challenges, whether that's uncertainty with global inflationary pressures or with interest rate policy impacting data. But that trend's not seen in the US, and that's what's caught investors a little bit off guard over the past couple of days. And a lot of investors are actually dialing back expectations for US dollar weakness into 2023, the final part, and hopefully into next year. And instead, we're now expecting the dollar to remain strong, which obviously is going to be a problem for global markets, global currencies, and for inflationary pressures. And that's what's weighing on sentiment at the moment.
All right, Jamil, if we go to China, or if we look at the share price of Apple, rather, falling for a second straight day, that's amid that ban by the Chinese government saying if you work in a government entity, you cannot use an iPhone. Concerns about those rising US-China trade tensions and what that's going to mean. Take me through that.
So if we didn't have enough global economic risks for the macro financial landscape when it comes to interest rate environment, uncertainty over inflationary pressures, we now have another thing that's come into the mix. Generally speaking, the Apple is the largest company by market capitalization. But the problem here is that China is actually a major revenue stream for Apple, which is why the share price has lost hundreds of billions over the past couple of days. And that trend can continue should this report be confirmed. At the moment, it's unconfirmed reports that government workers have been used to stop using the iPhone. And if that was confirmed and then rolled out throughout the rest of China, that would be a major spanner in the works for the Apple stock, which has performed resolutely in the global environment in 2023. But we can see further declines in the share of Apple if that report has really come to surface.
Okay, let's stay in China. Their currency slipping to its weakest since 2007. Why?
Emerging market risk somewhat, and also because of the expectations that Chinese officials now are more comfortable to see weakness in the yuan. This is for two different reasons. Firstly, because of global relentless USD power, dollar pressure, rattling global currencies, but also because we see that the Chinese economy has not been able to bounce back from lockdowns as swiftly as we would have hoped. We have to remember now that although the rest of the world was exiting lockdowns as early as 2 years ago, maybe 1 year ago, in China, actually, the economy's only really reopened over the past couple of months. And it's like getting a car back up to speed again. Now, that car's not fully back up to speed, which is causing a problem for the Chinese economy firstly, but it's a problem for the world economy because everybody's so reliant on Chinese trade. But what it's looking like it's going to be likely here is that officials in China will continue to push for weakness in the yuan, not just because of the dollar pressure rattling global currencies, but also to push export demand for Chinese goods as a safety net to try and bounce away from what has been these lockdown pressures.
Okay, and then the ECB is meeting the next few weeks. I know that's always of interest to the markets, what may happen with interest rates there. Less than stellar data out of Germany this week. Just take me through what else moved the markets in Europe.
When it comes to the interest rate policy, it's actually expected the European Central Bank have done pretty much as much as they can when it comes to raising interest rates. That's not the same for some of its peers, such as the United Kingdom and the Bank of England. But generally speaking, European economy continues to be hit by global pressures. Some of the data from Germany this week has been concerning, and it does show that the final quarter of 2023 will still be a negative one for the European economy. So what I expect from the ECB, the European Central Bank, is to say that we have a lot of downside pressures. The European economy continues to need support. So even if the euro receives some support through a more consistent central bank policy, it wouldn't surprise me if the ECB officials try to talk down the euro purely because of how strong the dollar environment currently is.
And then, Jamil, when you're looking at the week ahead, what are you watching, whether it's commodity prices, whether it's a certain market?
I'm watching the gold price. The reason why I'm watching the gold price is because we've seen quite a spin lower in the past couple of days in value. The gold price dropped just over $20 this week, purely based on the dollar strength. But I think what we also need to look for is the narrative that comes out of the upcoming G20 summit, which is taking place in India, because it is quite noticeable that China is not going to be present at this summit when it comes to the leader not taking part. So that's the first time since 2008 that that's happened. But I think that officials are very much going to want to try and collaborate together to improve the economic environment. But as soon as we still have inflationary pressures, such as the oil price touched $90 this week, we still have an uncertain environment for the rest of 2023. So the question to ask really is, what will the G20 summit achieve to try and improve the macro environment? And that's where there is some skepticism.
All right, Jamil Ahmed, Chief Trading Analyst at GTC. Thank you so much for your time on SABC News this afternoon, just giving us insight into international market movements, what's happening there. It's time for a short break. We'll have SME on point when we come back. Do stay with us on SABC News.